Welcome to our latest explainer, where we're embarking on an impartial and, honestly, pretty fascinating exploration of the global financial system. Today, we're unpacking a massively complex and deeply misunderstood pillar of modern economics, the tax haven. We're going to look at what they actually are, where they hide right in plain sight, and how they fundamentally shape global wealth.
To really wrap our heads around the scale of what we're talking about, we have to start with this absolutely staggering number, up to $348 billion. According to recent research, that is the estimated amount of tax revenue lost globally every single year. And why? Well, because a massive 40% of multinational profits are shifted across borders, completely away from the countries where the actual economic activity takes place. 40%. That is a truly huge chunk of the global economy being artificially moved around.
So, it forces us to ask a pretty profound question. How exactly does this happen? Every single day, you and I, everyday citizens, pay standard and sometimes pretty high income and consumption taxes. Yet some of the most massive corporations and highest net worth individuals legally utilize these international systems to pay just a fraction of those rates. It's a paradox that sits at the very heart of the global economy. And to truly understand it, we need to completely rethink what we think we know.
Let's start with Section 1, the tax haven myth. We've got to start by shattering some preconceptions here. When most people hear the term tax haven, the typical image that pops into their head is, well, pretty glamorous. A sunny, tropical island resort where shadowy figures arrive with literal briefcases stuffed with cash. But that's the Hollywood myth. The reality? It's radically different. Modern tax havens are often rainy, bustling, highly compliant corporate hubs absolutely packed with skyscrapers, accountants, and lawyers. They promote themselves as knowledge economies, not pirate coves.
In fact, today's actual definition of a tax haven is way more sophisticated. It isn't just a country with zero taxes. It's a jurisdiction offering minimal tax liability, sure, but also strong financial privacy or incredibly advanced profit-shifting tools. Some of the biggest corporate havens actively reject the label entirely because their headline corporate tax rates aren't actually zero. Instead, they offer complex legal frameworks like base erosion and profit shifting, or BEPS tools, which essentially give companies legal avenues to move profits from high-tax countries to low-tax ones to shrink their global bills.
Let's move to Section 2 and see how this builds, mapping the global havens. To understand where these powerful financial centers actually are, we need to make a really critical distinction between two types of havens. On one side, you have traditional havens, often called sink havens. Think of places like Bermuda or the Cayman Islands. They often have straight-up zero corporate tax and act as the final resting place for funds. On the flip side, you have corporate havens, or conduit havens. These are places like Ireland, the Netherlands, or Singapore. They don't necessarily have a 0% rate, but they have extensive bilateral tax treaties and specialized legal backdoors that allow huge flows of corporate money to be seamlessly routed through them.
Comparing the top havens for 2026 really reveals how tailored these jurisdictions are. The Cayman Islands offers 0% tax and totally dominates banking and insurance. Then you look at Singapore. It has a 17% corporate rate, but operates a territorial tax system, which makes it a massive hub for technology and trading in Asia. Switzerland, with effective corporate rates sitting between 8.5% and 18%, is basically the gold standard for private banking and asset management. And the UAE? They offer 0% corporate tax within specific free zones, drawing in tons of global real estate and energy money. Different havens attract completely different industries.
Which brings us to Section 3, why the wealthy use them.
Now, it's not just faceless corporations using these systems. Let's impartially look at two of Europe's premier destinations for high net worth individuals, Monaco and Switzerland. They seem similar on the surface, but they operate completely oppositely. Monaco is a true zero personal tax jurisdiction. If you move there, you pay absolutely 0% on personal income and capital gains. But the catch is, you must invest heavily in extremely expensive real estate and spend over half the year there. Switzerland, on the other hand, keeps its ordinary tax system, but offers what's called a lump sum tax. An eligible wealthy resident basically negotiates a fixed annual tax bill based entirely on their living expenses in Switzerland, completely ignoring their actual worldwide income.
And honestly, the appeal goes way beyond just tax efficiency. These jurisdictions offer incredible, completely legitimate lifestyle and legal incentives. We're talking robust asset protection against legal disputes. They serve as intense networking hotbeds for global elites. And perhaps most importantly, places like Monaco and Switzerland are among the safest, most politically and legally stable environments on Earth. If you're a global billionaire, this literally ticks all the essential boxes.
Shifting gears a bit, let's head into Section 4, the missing billions.
Now, what's really interesting here is that while individual residency is fascinating, the true weight of the tax haven paradox lies with multinational corporations. Just look at the sheer disparity. Researchers look at a metric called the ratio of pre-tax corporate profits to wages. In normal non-haven countries, foreign firms are usually a bit less profitable than local ones, sitting at a profit-to-wage ratio of around 30 to 40%. But in tax havens, there's no comparison. The ratio explodes. For foreign firms operating in Ireland, for example, that profit-to-wage ratio can hit an unbelievable 1,600%. Enormous profits are being reported on paper in these jurisdictions that entirely mismatch the actual physical economic work happening on the ground.
And this isn't exactly a new phenomenon, but it is an accelerating one. Back in the 1970s, less than 2% of multinational profits were shifted to tax havens. Fast forward to 2019, and that number had absolutely skyrocketed to nearly 40%. The artificial shifting of paper profits has just been relentless. It's grown into this massive system that shields roughly $1 trillion of corporate profit today. $1 trillion! All right, let's look at Section 5, the winners and losers.
This systematic wealth shift has profound economic impacts across the board. And there are distinct winners. The haven economies themselves receive massive influxes of capital, which builds thriving financial sectors and creates very real jobs for their citizens. Plus, some leading economists point out that tax havens actually spur a healthy competition. They essentially force high-tax nations to reconsider overly restrictive regulations that might otherwise drag down their local economies. And, of course, the corporations and their shareholders win by maximizing their legal after-tax value.
So the crucial point is, what happens to the other side of the scale? Well, the losers are the high-tax and developing nations that watch their global tax bases just erode away. Remember that $200 to $348 billion in lost tax receipts we mentioned earlier? That is money that isn't funding public services, infrastructure, or human rights initiatives in the actual countries where the sales and labor happened. Furthermore, when average, hardworking citizens read headlines about incredibly profitable companies paying near zero taxes, it causes a severe decline in tax morale, which is the public's willingness to just willingly comply with the tax system.
Moving into our final part, Section 6, surviving the global scrutiny.
Now, with so much money on the line, governments haven't exactly been sitting still. There have been massive, highly coordinated international crackdowns. In 2013, the OECD initiated the BEPS Action Plan, specifically to close loopholes. In 2017, the United States passed the Tax Cuts and Jobs Act to lower domestic rates and actively penalize overseas profit hoarding. The EU has gone aggressively after preferential tax deals. Yet, as we look at the landscape today in 2026, corporate havens just continue to adapt. They comply with new transparency standards on paper, and they continue to thrive. The complexity of the global economy doesn't break, it just shifts.
And the wild part? The ultimate result of this decades-long tug-of-war is that over the past 40 years, as large nations try to aggressively compete with the appeal of tax havens, the global effective corporate tax rate has actually dropped. It went from an average of 23% down to just 17%. To make up for it, governments are increasingly relying on consumption taxes instead, which, you guessed it, impacts everyday consumers the most.
Which leaves us with this final, truly provocative thought. If the world's most powerful nations and coalitions are actively, aggressively trying to crack down on profit shifting, why does the tax haven system remain so resilient? Is it a fundamental flaw in global governance, or is it just an unavoidable feature of a hyper-connected, deeply competitive global economy? It's a paradox that clearly isn't going away anytime soon.